I think we're going to see gold potentially, based on Fibonacci, which is one of my favorite measuring tools. I think we could see gold. The downside target for gold is about 3,500. Now, this to me is a really good sign. This is a measured move. This is where gold technically, from a chart standpoint and momentum and all of that, is pointing to as the next support level. And if you notice on this chart, this is also right where it went into a euphoric feeding frenzy. And if we were to use Fibonacci based on silver, it's got a bit different price action. Instead of taking this recent one, it's actually, we can draw all the way from here. It is showing that we can go all the way down to about $40 an ounce in silver, which everybody is thinking is, insanely cheap, that it'll never get back down to that level. But that was also when everybody was saying silver's headed to $200 an ounce. And so when you have the mass majority of people not wanting something and they don't believe in it, usually that's going to happen. And so we could see a big correction in silver. And if silver was to wipe out down to this price range, it would be a great opportunity. Now,
gold and silver are volatile and uncertain, but this is likely a transition, not the end of their trend. The recent pullback fits a market resetting before its next move. Chris Vermeulen, a technical market strategist, says we see a classic topping or consolidation, not an immediate rally. Sharp swings and reversals indicate the market is exhausting short-term buyers. He stresses this phase requires risk management, as overstretched markets need time to cool off. During this, volatile moves can catch bulls and bears off guard. Now, we present the clips from Chris Vermeulen interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
I mean, there's definitely a few ways to play gold. It really depends on the individual, right? If you're an individual looking at the long-term picture, you think, the dollar's going to collapse and all hell is going to break loose, and, there's always going to be inflation and devaluation of currencies. If you're just a long-term holder, you got lots of time. I mean, you can just buy and hold metals. I think long-term it will be great. You're right. We have been navigating this as more an active an investor. We ended up getting out of gold right around 5,200, somewhere in here. We also moved out of silver right at 113 when the markets were screaming, saying, hey, this is where the momentum is shifting. We saw all this unfolding. So we did exit at a very good point there. And now the markets are trying to correct. And so where we stand in terms of investors, when we look at this chart of gold, and we'll just zoom back a little bit more, right across here was a very significant move. Gold and silver were moving as that defensive play. And then this whole phase right here, we saw gold really break out, and this is where silver as well, we saw it become the crowded play. This is where it became a euphoric move, and everybody was just buying it, and people who've never been in metals before were piling into metals. This was an exciting run. I mean, I was a big holder of precious metals since 2019, since the new super cycle in gold started. So if we were to just zoom back, let me just let this chart load here. So if we zoom back on gold, 2019 is where the last super cycle for gold kicked in, which is right here. This was the breakout for gold. So I've been holding it there. I also bought some on the 2020 sell-off, both gold and silver. And so now we've come up to this peak, this euphoric type of top, which, believe it or not, actually looks a lot like what we saw in 2011. And silver is almost the identical chart of how it's not only moved, but how the pattern that's unfolding. And so while I don't think we're going to go into a 10-year sideways market, I think we're still potentially have a bit more of a pullback in precious metals. Now, this doesn't look like much in gold, so I'll just zoom back so we can go back to gold in 2008, but we saw gold and silver pull back. We saw gold pull back about 34%. We saw silver pull back over 60%. And I believe we're going to see, we've started this. And so if we were to fast forward to where we are today, I think we're going to see gold potentially, based on Fibonacci, which is one of my favorite measuring tools, I think we could see gold. The downside target for gold is about 3,500. Now, This to me is a really good sign. This is a measured move. This is where gold technically, from a chart standpoint and momentum and all of that, is pointing to as the next support level. And if you notice on this chart, this is also right where it went into a euphoric feeding frenzy. And the market is great at hurting the majority of people who chase pricing. And this whole blue box from here to here is where people chased and drove the markets higher. And it has a great way of coming all the way down and trying to shake out those short-term, fear-driven, the FOMO-driven traders who want to make money like everyone else. The market has a good way of doing that. And so I'm very, very excited to see this because I'd love to see gold back at 3,500. I think it'll be, if it gets down to this, I think this could be one of the last this will be like the last opportunity before it starts the next big rally, which could be $7,000, $8,000, $10,000 over the next, decade or so, however long it's going to take. So I like this. There's a lot of people that don't want this because they just want it to keep going higher. But this to me would be the most bullish scenario. This would be a measured move, an unwinding, a correction within a massive cycle to the upside. And then from here, it's going to go a whole lot higher. Now there's another scenario for silver. Both of either one of these could happen is we've had this giant run up. And now we've got this bull flag. This is known, if this market consolidates and starts to actually show signs, it could just continue to go a whole lot higher. And then we go up to that, $7,000, $8,000, $10,000 mark sooner than later. But either way, you just need to know when to move in, when to move out of precious metals and follow the price charts, which is what I do. So right now I'm looking and hoping for a bigger correction. I do believe the economy is very close in the stock market to a big sell-off, which will drag gold and silver down for this, I think, kind of huge opportunity. I'd say once in a lifetime, but this cycle happens a few times in somebody's life cycle. So it could be the last time in some people's life cycle to be able to pick up gold before it screams higher and doubles again. So let's go take a look at silver real quick, because I think silver has a similar type of price action. It's had this huge euphoric move. It's consolidating. And if we were to use Fibonacci based on silver, because it hasn't fully, it's got a bit different price action. Instead of taking this recent one, it's actually, we can draw all the way from here. It is showing that we can go all the way down to about $40 an ounce in silver, which everybody is thinking is, insanely cheap, that it'll never get back down to that level. But that was also when everybody was saying silver's headed to $200 an ounce. And so when you have the mass majority of people not wanting something and they don't believe in it, usually that's going to happen. And so we could see a big correction in silver. And if silver was to wipe out down to this price range, it would be a great opportunity. Now, there's a bit, let's just take this other scenario as well. We can do the similar one as gold. We got the sell-off. We've got this bear flag, and it comes down to about 42. So the low 40s, if silver was to correct with the stock market and the economy, we see the US dollar take off, the dollar is getting primed and ready for a huge rally. It is going to hit silver very, very hard. And then silver down in this range is going to be like, back the truck up. This will be the time to pick up, either stack more metals, or in my situation, this is where I'll be re-entering and repurchasing a ton of metals to go forward, physical metals, just to store probably for the next 5, 10, 15 years, a very long-term position. So again, silver has got this scenario, Elijah, like gold, that it's rallied up and it is creating this long bull flag pattern as well. So if silver does start to move up and starts to break some of these resistance levels, silver could at that point continue to go to 200. So that's what I'm looking for. My biggest fear when it comes to precious metals or any investment really is wasting time. And so let's just zoom back just so we can get this scenario here of what I do and why I do it. Now, what I focus on is this type of euphoric move is actually very similar to what we saw over here. And again, it took took like 14 years to break out to new highs. I don't want to get stuck holding metals for that if we enter that. The other scenario is we are right here, and it's going to be a very short-lived sell-off, and then we're going to see the next huge opportunity. So silver could have a further correction here and then start to really, really take off. So those are kind of I think the two scenarios that are going to happen is we're either see silver start to break out, generate a new buy signal and say, okay, we can get back into silver. We should have imminent return. It should start to take off. Or we're going to continue to see it consolidate, find a bottom, start to turn up, and then we can invest in it when it's way undervalued and is a great long-term position to double, triple, quadruple returns from this level again. So that's the scenario. Most investors obviously don't know when to move in, when to move out of equities. That's what I specialize in. Precious metals is what I've been doing since pretty much 2001. I got into it, really focused on it hardcore since early 2007. And so I live and breathe this space, and I fully believe in it. I'm a gold bug, but I can also sell my gold when I know I'm getting a really good premium for it, and I can reinvest, purchase more gold later when I believe it's going to have quick returns, or I can buy it at a discounted price.
The key takeaway from this phase is caution. While long-term fundamentals may eventually support higher prices, the current technical setup suggests downside or sideways action could persist longer than many expect. Markets that have rallied strongly tend to correct not just in price, but in time. This period means traders seeking fast breakouts are likely to be disappointed by continued market volatility. Gold and silver may correct further if broader markets weaken, potentially leading even strong assets to be temporarily sold off. The key takeaway here is to prioritize capital preservation over aggressive strategies. A longer consolidation could build a stronger foundation for future moves. Until there are clear momentum signals for buyers, patience and discipline are critical. Let's get back to the interview.
We'll flip to the daily chart. We'll look at the shorter term chart here because it gives us a nice visual. So the dollar has been under pressure for the past year or so. It has been trying to build a bottom. There is a resistance level right through here. So this looks like it's trying to put in a rounding, a bottoming formation. If the dollar breaks out above this 100 mark and can hold and starts to extend to the upside, this is where we're going to see precious metals really take a hit. They're going to really start to sell off and have those legs down that I just showed you, which again, I think is a very good sign for the market. If the dollar breaks and goes to the upside, this means there's going to be more global uncertainty. This means the equities markets are probably selling off. The dollar is still the global reserve currency, and when kind of all hell breaks loose around the world, it tends to shine. It tends to rally and move up very well. So there's a big potential move here, a 10% move, a very clean 10% move in the dollar to the upside, which means metals are going to get hit very hard, not only from the rising dollar, but also just from the selling pressure. When everybody becomes fearful and they start liquidating investments, they get scared, there's margin calls, we see precious metals naturally get sold off. Even if it is still the best investment of them all, it can still get pulled down with the rest of them. And so that's kind of the scenario. If we look at the big monthly chart of the dollar, we can look at the dollar here and just draw some kind of lines across here. Overall, the dollar is channeling to the upside. It's just been working its way higher. It trades sideways for 5 years or so, and then breaks out, and then trades sideways for 5 or 6 years, and then kind of breaks higher. It's trading sideways again, and it's on the verge of having a big move up, potentially to 114, maybe even 120, which is huge, and that will put that pressure on gold. And when we go back and we look at what happened in 2008, if we just zoom in on this chart right here, in 2008, we saw the dollar take off to the upside. This is where gold fell 34%. These like 4 months here, gold fell 34%. We saw silver fall over 60% while the dollar moved higher. And, that was, we just kind of get a move here. That's about a 20% move. And the current move in the dollar shows we could go about 20% to the upside as the full big picture range. So to me, this whole perfect storm has slowly been brewing over the last several years. Precious metals, I think, just had potentially their blow-off peak. I think equities are very close to putting in a top. If they haven't put in a top yet, I think we're very close to it. The dollar's close to putting in a very strong bottom. And, we got war. We've got all of these things coming together, which typically happen right before a major correction in the economy and the equities market and more or less commodities as well. So Again, I think the key comes down to what type of investor you are. I think if you're like me, an active investor, and you can let go of metals, well, I think it's too late. It was more or less too late now. I think there's, I think selling near upper ends of the range and accumulating near the lower end is kind of the way to go for precious metals. I think there's going to be a great opportunity to buy precious metals either at a higher price, but when you get in, it's just going to keep on running. You're going to have return very quickly, or if we're going to see a lower correction in gold and silver, and you're going to be ecstatic to load up and start stacking again at a killer price. Either way, buying it at a higher price just before it takes off is amazing. Buying it at a cheap, super low price is also amazing. It's just you want to make sure you navigate those markets because we just don't want to see gold. And we never know. For all we know, gold could trade sideways for a very long time. And I think it's best just to wait for a signal and take action when there's a good opportunity. That's the big problem with like advisors, like money managers, is they have to keep money in the markets. And unfortunately, when everything goes down, there really isn't anywhere to go. That's why all the buy and hold portfolios and money managers who have to stay invested lose money. They watch everybody's accounts go down. As an individual investor, we can just step back and say, hey, I don't want to own anything. I think there's a couple ways to take advantage of it. One of them is, the simplest one is, know when we're in a bull or bear market. When we enter a bear market, just put your money in cash somewhere like where you're going to earn interest without any downside risk. So you can buy like an ETF like BIL. You can put it in a high interest savings account. You could just totally sidestep it, earn interest and make money while everybody else loses their shirts. Or you can play an inverse ETF. So if the markets fall, your account goes up in value. That's something that I do. I do both of these. We move to cash at times. We'll buy inverse ETFs for short windows to catch drops as the market collapses. And the other play would be potentially to move into a currency. Obviously, if your money is already in the US dollar, you kind of already hold the dollar. But as an international trader myself, you may want to move into an ETF like UUP or USDN or USDU, I think, is another ETF. So if you're an American and you have US dollars, you can actually still take advantage with an ETF for the rise of the US dollar index. And again, I just mentioned there's like 10 to 20% upside in just holding a currency, the US dollar currency ETF, which is a pretty darn good return if the stock market is to fall, 30 to 50%. So there's three ways to take advantage of it. And we kind of navigate all of them. We dance around and play all of those because each one may actually have a different signal at a different time. And that's what we do.
Looking ahead, the projections depend heavily on how this current phase resolves. If the market completes a larger topping structure, there is a real possibility of a more significant pullback before any sustained rally resumes. In that case, gold could revisit lower support zones, potentially surprising investors who expect immediate continuation higher. Silver, being more volatile, could see even sharper swings, amplifying both risk and opportunity. However, if this consolidation ultimately acts as a pause within a larger bull trend, the next leg higher could be powerful once it begins. Historically, markets that undergo extended basing periods often produce stronger and more sustainable rallies afterward. The critical factor will be confirmation. When momentum, trend, and volume align again, higher probability opportunities emerge. For now, the main message is to focus on protecting capital and waiting for clearer signals. Avoid trying to predict precise price moves. Instead, focus to overall market behavior when positioning. Share your thoughts in the comments below. If you found this analysis helpful, make sure to like, subscribe, and turn on notifications so you stay updated with our latest insights.